today for its latest policy decision. The question remains over just when that big central bank will begin cutting rates. Our next guest says that poor consumer price index numbers notwithstanding, that cut could come as early as June. Let's bring in Stephen Brown. He's Deputy Chief North American Economist at Capital Economics. Stephen, thank you very much for joining us. The conversation about the Bank of Canada and what it's going to do got a jolt yesterday from some inflation numbers that were decidedly softer than economists had forecast. Remind us what the picture is in the U.S.
Yes, it's looking completely different, really. So we did learn yesterday that in Canada, the 3-month annualized rate of the core inflation, so just excluding food and energy, that fell to only a little bit above 1% in Canada. Whereas in the US, we've actually seen an acceleration to around just over 4%. So completely different picture in terms of recent underlying price pressures. Now, we don't think the Fed's going to get too concerned just yet. The price data are volatile. When we look at the details of what's been driving higher prices in the US, there are reasons to expect it to be temporary and for disinflationary pressures to build again. But it's just that the Fed obviously needs to see some confidence that inflation is going to head towards 2%, particularly considering that the US economy is still continuing to do a lot better than the Canadian economy.
Hi, Stephen. Ryan here. Do you anticipate any changes to their dot plot? I believe in December they were projecting 3 cuts for this year. Any changes expected on the dot plot? And then finally, how many cuts do you anticipate over this next year, over this cycle?
Yeah, I think the dot plot is really where it's going to get interesting today. So we know that the policy statement is well crafted. It's kind of a consensus view of the board. Is likely to reiterate that the Fed still needs to get greater confidence that inflation will fall to 2%. The dot plot is interesting though, because obviously that's the contribution from all the members. And when we look at the median projection, which is for 3 interest rate cuts this year, that group is only the median by 1 member. So it's only going to take one of those people to change their view and say to project just 2 rate cuts for the whole median to fall to 2 rate cuts rather than 3. And I think that's where the big concern for investors should be, because when we look at what markets are pricing in at the moment, it's more or less exactly what the Fed is projecting, 3 cuts for this year. So if we do see that median change, there's obviously a risk of a bit of an adverse reaction. For what it's worth, we continue to think there could be 4 cuts this year, but there are some risks to that view at the moment.
And when do you see cuts beginning? You say in your most recent report you've already pushed back your forecast for the first cut to June, but even that is looking less certain.
Yes, I think we're still comfortable with that on the basis that we believe the rise in price pressures in January and February was temporary. So we should see more encouraging data over the next couple of months before that Fed meeting in kind of the mid to late of June. But obviously, given the way things are going at the moment with some of the kind of like rising goods prices, we think that's going to be kind of reversed, but there is this risk that it's more a reflection of the disruption to global shipping we saw at the start of this year, in which case it could take a little bit longer to come out of the system again, which could persuade the Fed to wait a little bit longer until maybe the July meeting. But I think June is still very much a good base case. When we think about the way that the Fed is going to be thinking about the stance of policy, it's really in terms of the real policy stance. And we know that even if inflation is taking a little bit longer than the Fed would like to fall, it is still set to fall in the coming months. And that means the real stance of policy is getting tighter and tighter. And even though the economy has been doing quite well up until now, we're seeing signs of cracks emerging. Household delinquency rates are now rising quite concerningly. And I don't think the Fed's going to view that situation as one that requires even tighter policy and real stance. So it's really about now finessing where the real stance of policy is, which calls for at least a few rate cuts this year, which is, as the Fed is projecting.
Hi, Stephen. I'm wondering, do you have a forecast outlook for the long end of the curve, the U.S. 10-year Treasury? I'm asking selfishly. We're considering increasing our treasuries, and we're looking for an entry point. I think we're getting close. I'm just wondering, right now, I think we're around 4.3 on the 10-year. Any outlook for that yield?
Yeah, so we're forecasting the yield to drop back to 4% by the end of this year and remain there next year. I think at the moment, the chance of it falling any lower is obviously limited given the resilience of the economy and recent inflation pressures. We would really need to see something quite surprising, such as, a very rapid drop back in the rent components, perhaps that is what the new tenant repeat index is showing us. So some of the leading indicators are pointing to that. But at the moment, it's just not a base case. So, we do expect the yield to drop back, but we don't see it falling, to anywhere near what we might have seen before the pandemic.
So your base case is that rate cuts are coming, but you do say at one point in your most recent note, rates might not be cut at all this year if the recent leveling off in core inflation is sustained. What would it take for rates not to move at all in 2024?
Yeah, probably two things. One would be that we've got the inflation picture wrong, and this is a genuine pickup in inflationary pressures again. We don't think that's the case, given that we are seeing signs of the economy weaken, and all of the leading indicators really point to more disinflation pressures to come. But the big risk is just that these things can take a bit longer than some of the models suggest. All the models are calibrated on the pre-pandemic experience, but we do know from, say, the 1970s that when inflation gets ingrained in the system, it can take a long time to get it out again. So that's one risk. The other risk, and I guess it's more of a positive one, to be honest, is just that the US equity market continues to do extremely well, because obviously what the Fed cares about is not necessarily the short-term interest rate, but broader financial conditions. And if equity markets are doing extremely well, then that means financial conditions for firms are getting looser, even if interest rates remain relatively high. So if the S&P 500, say, surge to 5,500 or even above it in the next couple of months, rather than taking until the end of the year to get there, as we expect, then that could certainly give the Fed reason to be a bit more cautious when it comes to cutting rates.